Hi, I'm Kevin Walton with C2 Reverse, and I do reverse mortgages. The purpose of this video today is to compare a HECM reverse mortgage line of credit and a bank HELOC. There are some very distinct differences, both in qualifying for the loan and how you can use the loan. So at the end of the video, there's going to be a red box at the bottom of the screen that says subscribe. Please click that, because I'll be making additional reverse mortgage educational videos and you'll get alerted as to the next one that I make. So let's go ahead and jump in. So the first bullet point, the HECM has a growth rate attached to the unused portion of the line of credit. I'm going to make a whole separate video just on this concept, but just know this. The unused portion of the line of credit that you haven't used yet, every month it goes up. You get a bump, and it's tied to the interest rate. The bank HELOCs don't have that. So it's really important to know this. Over the years and as time goes by, it builds up to quite a number, and it's all available funds for you to use. You don't have to get another appraisal or anything else like it. For a bank HELOC, if you want to get a higher line of credit, you have to have the home reappraised. You have to reapply. Not so with the HECM line of credit. Really nice feature there. Also, the HECM does not require a monthly payment to pay back what you've borrowed. So how does that work? So every month, there's interest that accumulates on the reverse mortgage balance on what you have used. That interest, whatever portion you choose not to pay, gets tacked on to the balance of the loan. So it's deferred. All the deferred interest gets paid at the time that the home sells or the loan is refinanced. A lot of my clients make payments on their reverse mortgages. You can make whatever payment you want, however often as you want. And on the line of credit growth rate, you'll see making payments increases your unused portion that grows every month. It grows even faster when you make payments. So that's just an added bonus by making payments. But also qualifying for the reverse mortgage, you have to have a certain amount of income. So let's take a look at that real quick. This is a situation that I had just recently. 68-year-old single person has a home that was paid off and worth $600,000. She went into her bank to get a line of credit for $200,000. Her total expenses per month were $1,368, and her income was $1,500 per month from Social Security and a pension. So to qualify for the bank HELOC, one common formula is used to estimate what a monthly payment would be. It's the proposed line amount, which in this case is $200,000, times 1.5%. So in this case, that's $3,000. That's the proposed monthly payment you have to have that they qualify you with. You have to be able to make that payment, in addition to your taxes, property taxes, and homeowner's insurance in the form of a monthly payment, which in this case was $300. Plus you had an additional $260 per month credit card payment as well. So total payments are $3,560 a month. She had to have the ability to make those payments every month. But they're not going to use 100% of your income to qualify you. So in this case, she needed to show $8,000 a month to qualify for that bank HELOC. Now, for some people over the age of 60, it's not possible for some people to have this, because when they retire, sometimes their income drops, and if they're married and their spouse tragically passes away, it may even drop again. So it's very difficult for some people to qualify for these larger bank HELOCs, but the HECM line of credit is different. Income needed for this loan was $2,000 a month to qualify, not $8,000. And why is that? Reverse mortgages do not use the same income requirement ratios and formulas as other mortgage loans and HELOCs. We can also use what we call imputed income to help qualify for the loan. In this case, we can use the unused portion of the line of credit, the $200,000 available. Using a formula, it created $1,057 a month in qualifying income. And you notice I put income in quotes there. This really is not income. You did not earn it, but it is cash flow income to help make the numbers work. So 1,057 of the 2,000, we already met that just by using the funds available on the loan. So the balance needed per month was $943. Now, in her case, she had other liquid assets. She had 401k that was passed down, and also some checking and savings assets. We imputed that income as well using a different formula than the above scenario that I just described, and we were able to pull out an additional $1,000 a month in qualifying monthly income. So even though she got Social Security and a pension, I didn't even have to ask her for that documentation. It made it so much easier. There was already enough income to make this loan go. So to be honest also, some HELOCs, when you go to qualify, they may impute income as well. They may be able to draw some cash qualifying income out of other assets as well. But some lenders don't do that. But they do have that large qualifying payment. And in this case, this lady was not able to qualify for the HELOC, but easily qualified for the same loan amount with the reverse mortgage line of credit. So are all the same figures used for all reverse mortgages that I just went over? The answer is no. So the factors used in determining income qualifying for a HECM line of credit, and again, HECM is Home Equity Conversion Mortgage. That's the federal insured version of the reverse mortgage. The age of the youngest borrower, with a minimum age of 62 for the HECM, is one of the qualifiers. Prevailing interest rates. Now, some people tell me, Kevin, the older I get, the more money I get on the reverse mortgage. That is true. The older you are, the more of a starting loan amount you do get. However, we are in, as of August of 2021, in a rising rate environment. One of the other factors that goes into deriving your loan amount you qualify for is the interest rate. So if the interest rates go up 0.25%, for example, this time next year, you may be a year older, but that rising rate that went up by a quarter is going to wash away any gain you got by being older, and you'll lose even more on top of that. It is the most powerful driver when it comes to determining loan amount. So waiting until you're older is not really the wisest thing to do in this market right now. How many people living in the property? Value of the home and equity in the home is another factor. Region of the country in which you reside. There are some high cost areas like Southern California, where I am, where you need a little bit more left over at the end of the month than you do versus living in other areas. So again, each situation is uniquely different, which will generate a different loan amount and a different income needed to make the loan work. Many applicants already have existing first mortgages on their home as well, and that's okay. We just need enough equity to pay off that first mortgage and have additional funds left over after that for the line of credit. Now, there's also fixed rates available for reverse mortgages, but again, that's a different video. We're just comparing the home equity bank line of credit, HELOC, versus the reverse mortgage line of credit. But just want to point out that if you do have a first mortgage on the property, your home does not have to be paid off to get a reverse mortgage. So the bank HELOC has a limited use of time on it. So it's typically 10 years. It's a 25-year amortized loan, which means your payments are stretched out over 25 years. Your first 10 years is an interest-only payment. Then after the 10th year, your line is shut down, zeroed out. You can't use it anymore. And instead of an interest-only payment, you now have to make a principal and interest payment, and then they shrink it to a 15-year term. So you're no longer on a 25-year term, you're on a 15-year paying principal and interest. your payment is going to jump about 60%, the payment amount every month. Also, for some people on fixed income, that's rough. That's rough. So the reverse mortgage line of credit doesn't do that. It doesn't close after 10 years. It stays open the rest of your life. Also, on the bank HELOC, if property values drop by more than, say, 15, 20% in value, they can just zero out your credit line without you knowing. You have no say in the matter. They just zero it out. The HECM line of credit cannot be frozen because of dropping home values. It can go down 50% and it will stay open the rest of your life. So that's another very important feature. That money has to be there. When you need it, it has to be there. So those are the main differences in the HECM line of credit and bank HELOC. Again, that growth rate that's attached to the unused portion of the funds for you to use in the HECM line of credit is huge. It just grows and grows and grows. Now, as you draw funds from it, your unused line of credit goes down some, but whatever's left will keep growing every single month. And I'll have charts and amortization tables to show you for that. So I thought I would just make this quick video because the reverse mortgage line of credit really helped this borrower, because she didn't know what she was going to do. She didn't think she could get a line of credit anywhere due to her limited income, and things were getting very tight for her. This completely was a game changer. So if this helped, hopefully it did. It gave you some information. If you have any questions or concerns, you can feel free to call the number there. And please, at the bottom in the red box there, it says subscribe. Please click that. And then anytime I make a new video, you'll be alerted. And they're all educational, just like this one. So thanks for your time and watching, and stay well. Bye.